Ever seen a chart like this and been tempted towards a clear outperformer? It seems like the obvious investment decision, and it's very difficult psychologically to invest in a fund that seems to have underperformed. In fact, in my first year of investing, I have to admit I got drawn to a fund that had done exceptionally well recently, and well, yeah, it went on to crash by about 30% a few months later. That is an extreme example, and I learned the hard way, but I'm happy it happened then when I didn't have much money to invest rather than later on in my journey. This video isn't just about why charts can be misleading, it's about how they tempt us to chase performance, ignore market cycles, and make it very difficult to stick to plans. As investors, we hopefully all know the phrase, past performance doesn't guarantee future results. And there's absolutely no arguing with that, it's completely correct. Some of the top performing funds may go on to deliver underwhelming performance. But in this video, I want to take a deeper dive into this and explore exactly why looking at past performance charts offers very little value. Most commonly, we look at 5-year charts, and that is the focus of this video. And this is because comparison websites like Google Finance, Just ETF, whatever you use, they have 5 years as one of the main options to view the fund over, and it does seem like a decently long time horizon to judge it by. So in this video, I want to go a step further than just saying, don't trust past performance. We all know the disclaimer, but we don't often think about why that's true. I want to show you exactly why these 5-year charts are often misleading and how they're heavily skewed by whatever theme, sector, factor performed well in that period. 5 years is not enough to show how an ETF performed through different market cycles and rotations. Different styles, sectors, and strategies take it in turns, leading and lagging. And no, I don't believe there is any way to know what the next winning thing is or when it will be. The worst performer may very well continue to be the worst performer, or it could go on to have a stellar 5 years. Before we go any further, remember this video is not investment advice. I'm not a financial advisor. When investing, your capital is at risk and you may get back less than invested. Given what this video is about, it seems silly saying it again, but yes, past performance doesn't guarantee future results. Always do your own research, and if unsure about anything, consider consulting with a qualified financial advisor. Let's start with a few real-world examples to illustrate why exactly looking at the latest 5-year past performance chart can lead to some wrong decisions being made, and what exactly we can observe and learn from this. First up, we're going to look at a recent top performer, the VanEck Morningstar Developed Markets Dividend Leaders ETF with the ticker TDGB. This fund aims to track 100 of the top income payers globally, selected for their dividend yield, resilience, and likely growth. As it is a developed markets ETF, I thought it'd be best to compare it to a standard market cap weighted developed markets tracker. In this case, I went with iShares Core MSCI World, ticker SWDA. And we can see, over the past 5 years, TDGB has smashed the simple tracker, delivering a return of over 125%. Seems very impressive, right? Well, if we change the time from the past 5 years to a previous 5-year period, such as 2016 to 2021, look how different the 5-year chart is. Any investor looking back in 2021 and comparing these ETFs back then would probably have come to the conclusion that TDGB was a terrible ETF. It had massively underperformed the tracker. So we're getting our first glimpse here about how potentially misleading 5-year period charts can be. This ETF has gone from a horrific underperformer to a significant outperformer. It's a good example of how different types of stock do well in different periods. There's rotations between factors, sectors, themes, etc. In the case of TDGB, it tilts towards higher yielding companies and is very overweight financials. As we can see here, the sector composition shows it is nearly 40% financials. So if we then go back and look at past 5 years and compare TDGB to an MSCI World Financial Sector ETF, we can see that it correlates pretty well with financials doing well over this period. So in summary, it has had a good 5 years because the type of stocks that it tilts towards have done well. Investors looking at the chart back in 2021 would have found it very difficult to convince themselves that it was a good opportunity. But nonetheless, it turned out to be one. No one wants to invest in a loser. Okay, now onto a different type of ETF, the Wisdom Tree Global Quality Dividend Growth, ticker GGRG. I had this ETF in my portfolio for a while, but did switch out of it because it became difficult for me to justify the 0.38% fee when I can get a global tracker for as cheap as 0.12%. That's not the point of this video though. It's another one that serves as a good example of 5-year charts being heavily skewed by recent performance of a particular style or factor, or in this case, the performance of an individual stock. If we look at the past 5 years, GGRG has lagged a developed world tracker by a fair bit, around 58% compared to 84% for MSCI World. However, in a 2016 to 2021 chart, GGRG actually slightly outperformed MSCI World, and in general, both funds tracked each other pretty well. So, why did GGRG suddenly diverge so dramatically from a developed world tracker? Well, we have to remind ourselves how GGRG works. It includes quality dividend-paying stocks and is weighted by total dividends paid, not market cap. Therefore, companies that pay little or no dividends have a very small weighting in the ETF. GGRG therefore underperforms when low or no dividend companies deliver significant returns. It does not benefit because they're underweight or not included. And what low dividend stock has absolutely skyrocketed over the past couple of years? Yeah, Nvidia. If we look at a chart including Nvidia, is it any surprise that the ETF that has underweighted it has underperformed? Not really. Now, I'm sure it's not just the lack of Nvidia that causes underperformance, but given it had only a 0.1% weighting in GGRG last year compared to about 4% in a standard tracker, it must have had a significant influence. So does that mean GGRG is a terrible ETF? I don't know, you can decide. What I take it to mean is that this 5-year period just hasn't been good for focusing on quality dividend payers. But that tells me absolutely nothing about the future. Do I think that quality dividend payers are still a good long-term investment? Do I think that what has happened to Nvidia is typical? If you ask me, I still like the idea of investing in quality dividend payers, but there's no way of knowing for sure. My key takeaway point here, though, is that rather than making quick decisions about an ETF underperforming, and therefore not being worth your time, instead I would reframe my thought process to, why has it underperformed? Am I content with that reason? And do I believe it might be good going forward? I was going to keep on going for examples here. I was going to show momentum and value factor ETFs, but it would have just given us more of the same. I think we've gone through enough to establish the point being made here. These differences aren't random. They're driven by cycles and rotations. And that's exactly why 5-year charts are dangerous. They tempt us to chase what has just worked. But more often than not, the next 5 years will look completely different. Markets rotate, themes go in and out of fashion. If an ETF underweights or overweights the next winning sector, it has a huge impact. What looks smart to focus on today might look really silly in a few years' time. This is why any strategy that focuses on a specific factor, theme, or sector, like value, dividends, or quality, whatever it may be, can be hard to stick with. Even if it works over the very long term, there will be stretches where it feels like it's broken. And it may well be broken. We have no way of knowing for sure. But what I hope this video has shown is that we can be pretty sure that going all in a top performer based on a 5-year chart has a good chance of turning out to be a bad idea. Strategies that tilt towards a specific style or factor can definitely work, but they require patience and belief. You need to be willing to sit through periods of underperformance and not doubt yourself the second it starts to lag. With this in mind, I believe it explains why market cap weighted ETFs are so popular and easier to stick with. It's not just because they're diversified and low cost, it's because they're psychologically easier to hold. When a strategy like that underperforms, it doesn't feel like you've made a mistake because everyone else is in the same boat. Buying a standard global index fund or S&P 500 fund is the norm. You haven't deviated from the crowd. But when you tilt your portfolio towards a style or a theme and it underperforms, you are going to experience FOMO because all your friends seem to be outperforming with the simplest of strategies. You feel like you're losing while everyone else is winning. So let's be clear, this doesn't mean factor or sector investing is bad, or that you shouldn't use smart beta or thematic ETFs. If you believe in it and stick with it, it could turn out to be a good investment. It just means that you should expect performance to be lumpy, and the recent returns tells you almost nothing about the next 5-year period. You should expect these strategies to deviate from the market from time to time, because, well, you're not investing in a simple market tracker. Of course it's going to differ. This could further the argument for a core and satellite portfolio. Simple global market cap weighted fund in the core, and then other strategies, styles, factors, sectors, and so on as smaller satellites. This way, it's easier to deal with periods of style underperformance as it doesn't feel like your whole portfolio is being dragged down or that you're missing out. I have to say, I've been guilty of overestimating my conviction with factors and psychological strength to hold through periods of underperformance. That is why I personally no longer hold factor ETFs as my core portfolio. I realized I didn't want to handle those long periods of market deviation. I still like them and I think they can be good investments, just not for the majority of my portfolio. But that's just my thoughts, of course. Overall, I hope this video showed you to research further and not just read too much into a 5-year performance chart. It's not about choosing the current best ETF, and this is why in my ETF comparison videos, I try to focus more on the details and what it actually aims to do rather than the past performance. Next time you look at a chart, ask yourself, what does this mean in the context of the composition of the ETF? Do I believe in this strategy long term? What is driving the under or outperformance? Understanding a strategy and feeling comfortable with it will make it much easier to stick to. You may decide that a broad market cap weighted index fund is actually the best place to be. It's certainly the option with the least self-doubt, as you have the highest number of people in the same boat as you. Let me know your thoughts in the comments below. I know there's nothing groundbreaking here and it's not a profound insight, but I do think it's good to revisit these basics and remind ourselves the importance of not judging a fund based on 5-year returns. If you enjoyed the video, be sure to leave a like and subscribe for more. As always, thank you for watching.